Hey, Katrina Madewell here. This is Tampa Home Talk. Thanks for tuning in for another exciting edition of our show. And we have Miss Sarah Neher with the mortgage firm back on the show today, official show partner of Tampa Home Talk. And today I've asked her to talk about some of the different types of loans that are out there. Because a lot of times I think people think you just show up, you go to the bank, they give you a loan and boom. But there's a lot of things behind the scenes that you don't know that she knows, that she has to know inside and out. And there's a lot of different types of loans. So we'll talk about some of the big ones on down. Let's start with our veterans, the VA loans that are out there and some of the benefits of a VA loan.
Sure. So VA loans are fantastic. Obviously, in order to qualify for them, you've got to have enough time served, be active duty military or veteran.
Is that a 2-year period or what's the rule on that?
I believe it is a 2-year period. Okay. There are additional rules where maybe you've served enough time in the National Guard or reserves.
Got it.
So we can definitely double check that criteria. But let's say you qualified for a VA loan. What we would do is we would pull what's called a certificate of eligibility. And that certificate is kind of like your coupon to go shop and buy. Obviously, you have to budget for the purchase price and stuff like that.
Back in the day when they used to have that green form, we had to have the veteran go track it down. Do you remember that?
Well, that still exists. It's called a DD-214.
But no, it was green, and the green certificate eligibility was different than the DD.
Oh, okay, maybe it was back in the day.
Yeah, back in the day, it used to be a green form. The certificate.
So now in the current 2026, we pull that online, and it's instant. Yeah. So, but VA is great because VA, couple things. VA is zero down. Everybody loves that. It's a government loan. So it's going to have a lower interest rate than a traditional conventional loan, typically. VA doesn't really have a credit score requirement. The lender you choose might. They may have their own minimum credit score because they have to be able to sell your loan for servicing, and their investors may have minimum credit scores. But VA per se does not.
And they always want to try to lend to the veteran if they can.
They do. And lower, so
it's a guarantee for the veteran.
It's different for everyone's circumstance, but if it's a lower credit score, don't disqualify yourself. Lower credit scores, we close those all the time.
And that also means a lower payment because you're not going to have the mortgage insurance.
Yeah, that was my next topic. So in a VA loan, that loan is guaranteed. That's what your certificate of eligibility is giving you.
The Veterans Administration, because you
earned it, that they're going to guarantee your loan. And so because the loan is guaranteed rather than insured, you do not pay for that PMI, if everybody's heard that term, or MIP, private mortgage insurance. You do not have mortgage insurance in your payment. And that lowers your payment, gives you a bigger budget for which to purchase a home. The VA is going to be more flexible than a conventional product on the debt ratio. Talk about debt ratio. That's what you're spending versus what you earn and what you want to buy. So in a VA loan, you're going to be able to have a higher debt ratio than you would in a typical conventional loan where you would be capped at 50%.
How high have you seen the debt ratio go on VA loans?
You know what? I've seen it all. I want to say last year, I closed a client with a 64% debt ratio.
Wow, that's high.
Yeah, all lenders have to use the same exact automated underwriting system. And if it reads the data and likes it and you have a good quality, strong credit report, then it's very possible to get very high ratios approved.
Nice.
So we don't know until we try. And like I said, don't second guess or disqualify yourself. It can't hurt to know. But that's how a VA loan works. Now, if you are considered disabled more than 10% by the VA, then you are exempt from what's called their funding fee. So in a VA loan, we talked about that you don't have to have mortgage insurance in your payment and that it is guaranteed. But what the VA does do is they charge an upfront funding fee.
Which you don't have to pay it out of pocket.
You don't have to pay it out of pocket. It's financed in your loan. And it varies. Is this your first time using the VA? Are you a subsequent user? Like I've had 2 other VA loans in the last 10 years. Their funding fee will vary based on your status. But if you're considered more than 10% disabled, it's waived altogether.
That's nice.
So imagine if I'm a subsequent user getting a VA loan, meaning I've had a VA loan before, and I'm not disabled, I'm not 10% or more disabled, I'm not considered exempt, the VA is going to charge me, I want to say it's a 3.3% funding fee.
And if you've used your VA multiple times, that actually goes up.
Yeah, well, it's a fixed amount for subsequent user. But on a $400,000 house, that could easily add $12,000-$15,000 to your loan.
So it might not be the best loan program just because you got a VA loan in the past or whatever. It may or may not be your best.
We make comparisons. We do make comparisons.
This is why an experienced loan officer like Sarah is going to make those comparisons, look at all those loan programs and their rates, and help you determine what's the best one for you.
If you're at least 10% disabled, though, is hands down going to be a great program because there's no funding fee whatsoever. So that's kind of how VA loan works.
So let's talk about VA's sister, which I'm going to say FHA.
Yeah. So let's say you're not a veteran or active duty and you can't qualify for a VA loan. What is the next best program? And that's going to be FHA. FHA is a government-backed loan as well, administered by HUD. It has a low down payment. You can have as low as a 580 credit score and have a minimal down payment of just 3.5%,
which can all be a gift.
Yeah, and it can all be a gift. Correct. So VA is flexible in the sense that
or down payment assistance, which we talked about in one of our other shows.
Not until you move up to 640 on the credit score.
Okay, perfect.
Yeah. But if you've got a gift, a family member, you've got your own down payment saved, you can go in with as little as 3.5%. And have a lower interest rate than you would be able to get in a conventional loan. FHA does insure their loans. They will charge upfront mortgage insurance that is financed in your loan amount. Plus, they have monthly mortgage insurance. That monthly mortgage insurance does not move around like it would in a conventional loan based on your credit score.
Can you imagine it was like monthly mortgage minimum or something?
I know.
More tongue twister.
So it doesn't move around. It's a fixed factor. Everyone pays the same exact mortgage insurance rate based on your loan amount, whether your credit score is 580 or whether your credit score is 780, is fixed. And so that's a big difference for some folks because let's say I don't have a 580 credit score. Let's say I have a 640 credit score and I'm comparing an FHA loan to a conventional loan. I'm going to get a way better interest rate. I'm going to get substantially. Pardon me?
On FHA, way better interest rate.
A way better interest rate going the government route on FHA and a substantially lower cost of that monthly mortgage insurance because in a conventional loan, which we'll talk about, the monthly mortgage insurance is private. That's what that acronym PMI stands for, private mortgage insurance.
Versus mortgage insurance.
Which means it is credit underwritten. It does care about your credit score. It cares about everything, your debt ratio, your loan to value, your credit score, the type of property you're buying. So in those scenarios, FHA would be the kind of the way to go. So FHA is a great resource for non-military first-time home buyers. Or even if you're not a first-time home buyer. We talked about a lot of this down payment assistance where I say you must be a first-time home buyer. Yeah. FHA is for first-time home buyers, but you don't have to be a first-time home buyer.
But you can't have two FHA loans at the same time, right?
Not unless you have a very extenuating circumstance, like I am being relocated by my job more than 100 miles away, or my family has just expanded. We are pregnant with twins. And, there are probably 4 factors for which they would consider a second FHA loan. And there's a lot of critical underwriting criteria that pertains to FHA. Like I'm going to go get an FHA loan, but I'm going to retain my property and rent it out. There are things that you need to know as a borrower in terms of what you can and can't do that you want an experienced loan officer to dig into for you to be able to guide you in the right direction. Because maybe FHA seems beautiful, but there's this one little issue with your departing property, for example, that it's going to...
Departing sounds like you're dying. You mean the property you're living in that you're leaving.
Departing, right? No, so, but that's...
It sounds Linda lingo.
That's Linda lingo.
It is Linda
But there are some instances where the FHA may appear to be the best deal, but based on your situation, not so much. We need to go conventional to get some flexibility on a guideline. So again, working with an experienced loan officer that can guide you is going to save you a lot of stress.
All right. So we talked about VA. We talked about FHA. Let's talk about their geographic cousin, USDA.
Yeah, great. That was great. So USDA is another fantastic loan.
It's not just beef.
Yeah, it's not just beef. It's not just farms. So
that's the common misconception.
Right. So USDA is going to work similar to VA. USDA is also a zero down loan.
Government
loan, guaranteed, no mortgage insurance in the payment. USDA will charge, they call like a monthly maintenance fee in your mortgage payment, but it is far less expensive. Teeny tiny, far less expensive than mortgage insurance in general. Going to be a lower government rate, going to be zero down, just like a VA loan. And they also have a funding fee. Their funding fee is just 1% though, and that is financed in your loan. USDA is a fantastic program because of those things.
Yeah,
but
it's a caveat.
But here's the catch. Yeah. So
it's not a catch, but it's a super non-negotiable restriction.
It's geography specific. So you must buy in an area where USDA lends. So if you're in Pinellas County, you're not going to qualify for USDA loan.
There's nothing in Pinellas that
If you're in the middle of Tampa, you're not going to qualify for a USDA loan. You start getting east of 75, you're going to start picking up areas. You start getting into Apollo Beach, Ruskin, places like that, you're going to pick up areas. You go north, you get into Dade and Zephyr Hills, you're going to start picking up areas. There are places in Odessa, Land O'Lakes, Spring Hill, Brooksville. So depending on where you're shopping is going to depend on whether we would look at a USDA product for you.
We've seen this map area change so much in the time that we've had a working relationship. Like all of Pasco, I feel like used to qualify.
It did. And it honestly was a big shock to me because it takes a while for USDA's maps to catch up.
Yeah.
So back, before, I want to say 08, we had our whole meltdown. Remember when they were building Fishhawk?
Yes.
And Fishhawk is amazing. It's huge. It
was way before 08.
Totally populated. But we could write USDA loans there.
Which is shocking.
Because their maps hadn't caught up yet.
Yeah.
Well, now they're catching up. So it's not, they don't do a map review every 12 months, I don't believe. But they are catching up. And so we do have to make sure that the home's in an eligible area. And we do. We go into their site, we put in the address, and we report back to the customer and say, this one is eligible or this one's not. But if you just cross this major road.
Oh, we've seen that.
Now
we've seen in the same, it's not even a major road. Like we've seen in neighborhoods.
Throw a rock.
One side of the road qualifies, the other side. It's the most bizarre thing I've ever seen in my life.
Right. Actually, you sold me a house in Land O'Lakes years ago that was, it wasn't off Collier, but where's the outlet mall? What's that main road there?
It's Wesley Chapel Boulevard now.
Okay.
Yeah.
My side of Wesley Chapel, the left side going north on Wesley Chapel Boulevard was excluded and the right side was eligible for USDA. Anyway, so USDA is great, a really fantastic program if you find a home geographically where they lend, and it also has an income limit. It's over $100,000 for a household of 4. And
that's one of my favorite programs, by the way. Yeah. If you're eligible based on the area and the income, one of my favorites.
Yeah. And then
probably more than VA.
Right. It's gonna do like the standard bond does for the down payment assistance that we talked about in the last segment. USDA is going to look at the whole household. USDA is going to scrutinize a little more. So it wants the income of everyone in the household, and it's going to analyze bank statements a little more closely. It's going to make me prove a $5 deposit. And here's why. Because it does have an income limit, and they're just solely going off what was disclosed.
So if you're driving for Uber or Lyft, that's going to be a problem.
If you're DoorDashing and you're hitting the button, pay me now, and it's going into your bank account.
People don't think about that stuff. That's the stuff we see all the time. You definitely see it.
Yeah, I see it all the time. Even Zelle or Venmo. Hey, why did Christina put $100 in your account? Because I bought her lunch or dinner, or I lent it to her. Want to make sure you're not cleaning Christina's house, or you're doing some type of a side job to bring in extra income. They really do.
Do you have to document that and get letters from Christina? Or oh my.
We have to document it all.
Wow.
So yeah. So we love cleaning.
Not the most fun. Not the most fun.
Not to discourage anybody from that, because we love USDA loans. But that's my whole job, is to counsel a buyer before they ever even start shopping.
You're pre-underwriting the file. Let's not get this twisted.
So I need to have those conversations up front and say, hey, let's be as neat and clean in our banking as we possibly can, because I'm not going to need your life's history of banking. I'm going to need 2 months.
All right. So let's talk about the mom and dad of loans. Conventional.
It's
fair, right? The mom and dad loan.
Yeah. So conventional is another great product. Conventional loans are backed by either Fannie or Freddie. They both have different nuances. They're very similar, but they both have different nuances in terms of how those loans are underwritten. If you put 20% down in a conventional loan, you will avoid that mortgage insurance we've been talking about. Anything less than that, and there will be mortgage insurance in your payment.
Another little caveat too, you can waive your escrows. I mean, you can pay your own taxes and insurance if you do that.
As long as you put 20% down, you can choose to waive homeowners insurance and real estate taxes in your payment. You can never waive flood insurance if you're in a flood zone and required to carry flood insurance. That will always be escrow. But they do give you the option. And some people, it's just a personal choice. They prefer to pay it separately and on their own. So that is a feature that conventional will give you. Conventional does have we'll call it a first-time home buyer program, which will allow you to go 3% down. Fannie Mae's version of that program is called Home Ready. Freddie Mac's version of that program is called Home Possible. And depending on where your income falls in terms of the area median income limit, you could pick up some discounts on the mortgage insurance and things like that. So
these are the major types of loan products that most buyers and borrowers are going to fit under.
Right.
And without going through a whole Rolodex of other programs, and there's a ton of them, can you touch base on some of the other ones that are maybe not conventional or traditional or like the mainstream loan products?
Sure. So I'll talk about one more. And so a lot of investors use conventional loan products to buy property, right?
Right.
Because if you're getting any sort of government loan, VA, FHA, USDA, you must be owner occupying. So for an investor, conventional is always the way to go. But let's say you don't qualify for a conventional loan.
How so?
Well, conventional is going to have a more restrictive debt ratio. It's going to cap me at 50%. And let's say I'm self-employed.
You're writing everything off.
I write my income down as low as I possibly can, legitimately, right?
Yeah.
And I don't meet that debt ratio requirement to get a traditional conventional loan. There's a really fabulous program out there called DSCR. That stands for Debt Service Coverage Ratio. People love it. Even non-self-employed people love it.
Yeah.
Because even people working W-2 jobs might run into a debt ratio.
It's just easy.
It's easy peasy. The interest rates are very similar to a conventional loan.
Which is crazy to me, but they are.
Well, it does come with a caveat, but I'll break it down. So in a debt service coverage ratio loan, there are no hoops to jump through with respect to income. You're not giving employment. You're not giving W-2s, pay stubs, tax returns. There's no such thing as a debt ratio. In a DSCR loan, the whole loan is hinged upon a few things. Your credit score, which also determines the rate and whether you qualify for the program. Your assets to close. Do you have enough cash to close? And do you have reserves left over? Meaning you're not closing with $0 left in the bank. Do you own your own primary home? Because DSCR is designed for investors. It's not designed for people to buy primary residences, not document their income and go move in it.
Right.
So in a DSCR loan, you are buying strictly as an investor. You will attest to that on an affidavit in your loan package. So it's based on those things. And the main thing is the market rent. So the way a DSCR loan is approved is, okay, do we have a qualified borrower with credit? Do we have enough assets in reserve to close? Yes, we do. Okay. What is their new mortgage payment going to be? Whether they waive escrow or not, they look at the full payment, principal, interest, tax, insurance. Okay. Let's say that total is $2,000. All right. So let's go order an appraisal on this property. When we do that, we're going to ask the appraiser to complete something called a comparable market rent schedule. That's going to tell us what's the going rate for market rent in that area for something of similar bedroom count, similar size, similar location, similar age. And if the market rent in the area is equal to or greater than your new mortgage payment, you automatically qualify.
What if it's $1,800 and that payment is going to be $2,000?
So then you fall below that ratio. And there are still options for that. It's definitely going to move the interest rate and the pricing, but there are ways to go. It doesn't completely...
Can they put more down and avoid that?
Okay. More down, the better.
What's the down payment requirement on the DSCR?
Probably 20%. Yeah. I'm sure there's some niche programs out there offering 15, but obviously everything correlates to rate. So if you can put 25% down, you're going to get a way better rate than 20. But at the end of the day, remember what we said. Those rates compete very closely with conventional in the first place.
Yeah.
In a conventional loan as an investor, you're going to buy a 1-unit property and put 20% down. 2 to 4 units, you're putting 25% down anyway, just to get in conventional loan.
So I'm not asking you to look at pricing today, but can you give me an idea how different the rate might be with 20% down versus 25% down on the DSCR loan?
6.875.
Compared to
going 25% down compared to maybe 7.375.
So it could be 0.5% higher.
Yeah. And depending on the loan amount, that can make a big difference.
If they put more down, can they get a better rate?
Every 5%.
They get a better rate?
It's going to adjust that rate positively.
Wow.
Yeah.
Okay. Is there a cutoff on that?
Down to 60. When you get below 60, you're basically maxing out on all credits you can get. And one of the other major differences between a DSCR for an investor versus a conventional for an investor is the DSCR loan is going to come standard with a prepay penalty.
Okay.
And most folks, we do a lot of DSCR loans, don't care. They're not trying to fix and flip. They plan to hold on to it for a while. They're self-employed. Their tax returns are never going to change. So they're not worried that maybe I could refi next year.
Right.
They're in that position. So
does that prepayment penalty last 3 years? Is that right, Norma?
Well, it's interesting because there are several, depending on the lender that you choose. A lot of the lenders that I use have a step down. So
Okay.
it's 3-year prepay, 3% the first year, 2% the second year, 1% and then gone.
Okay.
Other lenders, and I recently just closed one, will give even better pricing if you take a 5-year.
Oh, okay. Get a
And
better
so,
interest rate if you agree to keep the loan for 5
yeah,
years.
so for somebody with a really long-term goal, I would look at that. But that's really the only difference. And you do have the option to buy the prepay out. Still not give income documents. It's expensive to do that. So if you can tolerate it.
Most of the time it doesn't make sense.
Right. No. So most people are totally fine with 3 years because it's only 1% in the third year anyway. But if you can't, or you think your plans might change, you can buy it down to just a 1 year, a 2 year, or buy it out completely. So those are always going to be options there. So,
And then just to touch on a couple other products that might be good for like our self-employed borrowers, you guys do bank statement programs and just a multitude of other things.
correct. Yeah. So we have bank statement loans. Again, tax returns numbers don't look good on paper, but I make a lot of money and I'm putting all my money in the bank. That's what bank statement loans are for. So in a bank statement loan, we're going to take 12 bank statements in a row, your most recent 12 months. And we're going to average your deposits over 12 months. Transferring from one account to another doesn't count. True deposits going in related to your income.
Now, Sarah, are they looking at your personal bank statements, your business bank statements, both of them? Does it matter?
You can look at either.
Okay.
And many of the lenders we work with will look at more than one account.
Okay.
Yep. So we can look hey, maybe you're a sole proprietor on Schedule C, you're putting all your money in your personal account versus somebody incorporated with a business account. We can look at a multitude of accounts.
Okay.
But the short story is we're going to take your deposits over a year and we're going to average them. We're going to exclude things that we know aren't income, like a refund or a transfer from another account or, Aunt Clara that just paid you back, something that's obviously not. If we see large deposits that don't look really conducive to the rest of the deposits or to your industry, we're going to ask you a question about that specific deposit. But the gist of it is we're going to take bank deposits over a 12-month period, and then we're going to apply what's called an expense ratio to that. The standard expense ratio is 50%. So let's say I made $150,000 in deposits in a year. I'm going to apply a 50% debt expense ratio to that. And I'm going to say, okay, we have $75,000 in income to work with. Let's divide by 12. But what if the client says, but wait a minute, I don't have 50% in overhead expense. I don't have brick and mortar. I don't pay for inventory. I don't really have a lot of employees. My expense ratio is a lot lower than that. Okay, great. We can lower that expense ratio.
So let them document it.
We just have to document it. So I could take a 50% expense ratio and take it down to 20%. Now that borrower is getting credit for a lot more than $75,000 in income.
It sounds like a good business I want to invest in.
But when I do that, I'm going to need CPA letter to back me up. I'm going to need additional docs. So that 50% standard, that is with no extra documentation needed. And so we try to make the numbers work that way if we can. Otherwise, we go another step.
Do they have to be self-employed to qualify for that program?
Typically, they are self-employed.
Okay.
Yeah. Yeah. But that doesn't mean when you're self-employed that you can't have other forms of fixed income. I do lots of loans for self-employed people that collect Social Security.
Got it.
Yep.
Great point.
Yep.
Great point.
Yep.
Man, this has been a great show. We kind of rapid fired through a lot of the loan programs, but at the end of the day, to know all this stuff would make your head spin, and the amount of stuff this girl has in her head that doesn't have to look up is shocking, but she's got it all up there. Our off-air number, in case you want to reach out to us, and we'll get you connected with Sarah at the mortgage firm, 813-377-2775. You can call or text that off-air number, 813-377-2775. Sarah, thanks for hanging with me today and talking about some of these jazzy loan programs. And wait, there's more.
Wait, there's more.
We'll talk about that in person on a different day, and we'll let you know which loan programs are you're best suited for, because everybody's scenario is different. So I'm Katrina Madewell. You're listening to Tampa Home Talk. Love where you live, or we'll fix it. Welcome home.